John. So I'm Marianne Bartels. I'm the Chief Investment Strategist at Sanctuary Wealth, but some of you may remember me from Merrill Lynch or Bank of America, where I spent most of my career. I'm probably most known for running the technical department, but I also spent a number of years in the CIO office at Merrill Lynch. And I'm going to ask each of my panelists to give a little bit of a description of who they are and what they're currently doing. Jim, we'll start with you.
I'm Jim Bianco. I'm the president and founder of Bianco Research, which I started 28 years ago, located in Chicago. We have two lines of business. We are a macro research firm that publishes research for our client base. And we also do manage an active fixed income index called the Bianco Research Total Return Index. And our partners at Wisdom Tree have an ETF that tracks it under the ticker of WTBN.
And Neil?
I'm Neil Dutta. I'm head of economics at Renaissance Macro Research. We are a sell-side broker-dealer that specializes in providing macro research solutions to buy-side investors across the core pillars of macro investing, strategy, economics, and policy research.
So I've had the pleasure of working many years with John, and I've had the pleasure of working many years with you. It's such a small industry. You know, we're in the month of October, so it's kind of a trick-or-treat type of month. And the equity markets and the bond markets have been pretty much of a treat. Maybe a little bit of volatility, but where we are right now, we've had some pretty decent returns. But, you know, we've had some trickiness. We are currently in a government shutdown. Now, all the studies, if you look at previous government shutdowns, it says it will have no impact on the economy. It'll have no impact on markets, but every time, at least when I'm turning on the television and when your clients are turning on the television, they're hearing about a government shutdown. And I think we're at a point where it kind of feels a little unnerving. We're running about 20 days. This is probably around the second longest shutdown. Trump was 34 days in his first term. What are you telling your clients about the shutdown? And I'll start with you, Jim.
Two things. First of all, a little definitional thing. Let's not confuse the shutdown with the debt ceiling fight, because a debt ceiling fight is a form of a shutdown, but the difference there is that you're talking about the potential of default because they can't pay debt. That is not the case with the shutdown. The other thing I've been telling them is there's a difference between having a Republican or a Democrat as president during a shutdown. During a Democrat as president of a shutdown, they seem to want to make sure that everybody feels the shutdown as quickly as possible as a forcing mechanism to try and get it to end. But under a Republican, they go out of their way to make sure no one notices it. And that's why it seems to last a lot longer, why we had the record under Trump 1-0. And that's why we're seeing this thing lasting so long. Most people hear about a government shutdown. If you ask them, how's it impacted themselves, other than maybe people in the financial market saying, we didn't get the payroll or the CPI report, not much. And there isn't yet a forcing mechanism to force you know, either the Republicans or Democrats to come together. And so it probably will just continue until something changes the status quo. Neil?
Yeah, I mean, I think you know, everyone's inbox is like bombarded by Wall Street analysts saying, how much do you think this is going to cut GDP by? And everyone comes with the same conclusion: oh, 1/10 or 2/10. Anytime there's like a shock to GDP of some magnitude, it's always 1/10 or 2/10 a week. But I do think it's probably happening at a sort of tricky spot for the economy. You know, obviously labor markets have been slowing, and you know, the reason no one thinks it's a big deal is because there's always back pay, right? So the shutdown ends, and the people that were off the job get their pay. And so that means that they tend not to do anything different with their consumption. That's obviously what's different now, is that you have the president telling you that he's planning to fire all these people. And it's an open question whether they're all brought back. So that to me makes it a little bit different than before. So I do think it's coming at a sort of softer spot for the economy. And this is, again, on top of, you know, lots of people taking the deferred sort of program, the Doge 1.0, and now Trump seems to be wanting to do a Doge 2.0 with this. So, you know, we'll see. I tend to think that it's probably matters a little bit more than it has in the past.
So the other spooky thing that we've been having to deal with are tariffs. They seem to be ongoing. And from what I can tell, it seems like the bond market actually likes the income coming from the tariffs. So, Neil, What's your view on tariffs? Are they good? Do we have a positive coming out of them, or are they overall going to be negative for us?
I mean, I don't think you'll really find any economists to say that this is good for us. What I would just say is that the inflationary consequences of it hasn't been as onerous as we may have thought earlier, and that's because nominal growth is generally slowing, so people don't really have the ability to absorb the higher prices that may come from tariffs. What we're seeing now is that a lot of the sort of cost is being eaten up by the importers, by the retailers. Not all of it's passed on to the consumer. There's also still a lot of uncertainty around what tariffs might look like, so that might be keeping retailers from fully passing on the costs. So I don't think you could say it's a good thing. And keep in mind that we're not actually collecting as much revenue as we should. There's a big gap between tariffs as they're announced from the president's mouth and then tariffs as they're collected at customs. And that's a pretty meaningful gap. So, I tend to think of the bond market as basically pricing in, a slower nominal growth environment. And I don't think it's really about deficit concerns per se.
I think, when you look at the tariffs, there's a couple of things to keep in mind. Economists headed by, Jay Powell, if you could call him an economist for this argument, keep saying that, it's a one-time price shock. If you raise tariffs one time, it's one-time price shock. But I've counted 14 times now they've changed tariffs just in the month of October. And we still have, and that does not include the 100% tariffs that might come on China, because those are in November 1st. So it's constantly being changed, and it's constantly being viewed differently. If you go back to April and May and June, there was some evidence that a lot of foreign countries and importing companies, think Walmart, were absorbing some of those tariffs to not pass them on to their customers. That was maybe the first 30 or 60 days. They're not doing that anymore. They're starting to pass those along. So I think that the tariff impact on inflation is still to come, and we're still not done changing with tariffs. So this is definitely an evolving situation. I agree with Neil that, in an environment where the economy is not doing a whole lot, it's going to continue to drag on the economy. So that statistic you mentioned, if you go with the Yale Budget Lab, they say that the average tariff rate this year, right now, is around 18%, where it was 2.5% at the beginning of the year. But the average tariff collected is around 10% right now. I think that difference between the 10% collected and the 18 marginal is going to keep closing with the average tariff rate coming up over the next several months.
All right, so one more spooky thing that we're having to deal with. It is the season of the crash, right? We just celebrated the 87 crash yesterday. Of course, we always know about the 29 crash, and we have Andrew Rorsaukin, who just released a book on the 1929 crash. Many people are speculating that AI is in a bubble and is about to burst. So the other thing that just happened is we had two regional banks that have issued some negative news. Jim, you've started to talk about liquidity in the system, particularly affecting the banks. And by the way, if you haven't seen it, it's very good. If you don't get Jim's research, he has a very good post up on X. Why don't you walk through some of the concerns that you're seeing that are signaling to you that there might be a liquidity constraint happening right now?
So I started off that post by saying that Wall Street is really good at analyzing symptoms but not causes. And that the problem you're seeing at the regional banks with loan losses might be a symptom, and the cause might be that liquidity is getting squeezed. There's trillions of dollars that banks are lending out, and if you throw in private credit, it's even a larger number. So what that means is every minute, every day, there's bad loans. There's always bad loans. There's always bad loans being announced. It's part of life. But certain times they matter, and other times they don't. So why do these matter now? Why does the Western Alliance and the Zion's announcements matter so much right now, as two examples? Because I think the liquidity is being squeezed. The Fed has been doing quantitative tightening now since June of 2022. They've reduced their balance sheet by $3 trillion. They are continuing to take liquidity out of the system. They knew that they had excess liquidity when they started. They wanted to get to more of a balance, but the problem is they don't know nor do I or anybody else, where that equilibrium level is. So they just continue to do it and continue to do it. But now we're starting to see signs that liquidity is being squeezed. The secured overnight funding rate, otherwise known as SOFR, which is kind of the benchmark for funding, has started to move up. It's at the widest levels we've seen in 5 years. There's a standing repo facility at the Fed that is for banks that need extra liquidity. That started to get used last week for the first time other than a month-end, quarter ends. We always get these window dressing things, but last week was not a month-end or a quarter end. So there's signs that liquidity is definitely, I use the word worrisome. Not a problem, but worrisome. And it's been trending in that direction towards worrisome for about 2 months now. And it's not surprising to me that when that happens, things like defaults, bankruptcies, start to matter more, because we're not in an environment where we could just kind of ignore it and move on. So that's why I think that the liquidity thing that's happening with the banking system is important. And the last thing I'll say is Chairman Powell knew this, because before we started talking about liquidity, beginning of last week, he made mention that we're starting to see signs that liquidity might be getting a little tight, and floated the idea that they might end quantitative tightening. I suspect they will announce it at their meeting next week that it'll be ended. If I had to guess, they'll probably reduce the amount of quantitative tightening and probably end it at the end of the year or something like that, not immediately. They could do that as well too, but they know that this is coming. And again, it's all because we're in this new, what the Fed calls ample regime, that they don't know where the optimal level is. So they're kind of feeling around in the dark. We'll take some out. Oops, we went a little too far. We'll stop. Do we have to add some back later? And it introduces volatility into the financial system.
So Neil, are you seeing any stresses? Are you concerned about any systematic risk in the financial system?
No, not really. I mean, my experience is that when people talk about liquidity, it means different things to different people. So for some people, it means the balance sheet. But how illiquid can things be when, I mean, credit spreads are as tight as they are and equity prices are as high as they are. So, to me, the stress is primarily, I have a very much like a household-centric view of the world out. So to me, the stresses are likely to build in the household sector because I'm probably a little bit more concerned about the labor markets and the broader U.S. economy. And so I think, to me, a lot of these financial stress episodes, it tends to be episodic, right? So it's not a problem until it is. And, I think the risk is that, you have to tell me why labor markets don't continue to slow down. And if labor markets continue to slow down, then the household sector will probably feel more of a pinch, and then that could create credit problems down the line.
So let's get into the Fed's dual mandate, right? So they have to fight inflation and they have to support the employment side. So can you each go through how are you thinking about the Fed as they're going into this meeting? We are supposed to get CPI on Friday. They brought the BLS people back in, so we should get CPI. The market almost has 100% priced in that the Fed will at least cut 25 basis points and maybe another 25 basis points in December. So give us kind of your outlook of that dual mandate. Where is the Fed in terms of employment and inflation? And Neil, why don't you go ahead?
So, I think to me, the risk with the labor markets are always nonlinear in nature. A few years ago, I had the view that there wouldn't be a recession, right? And basically, it was premised on a few factors. But first was that incomes were growing. The second was that the government was spending lots of money. The third was that the housing markets were fine, even though the Fed had been hiking very aggressively. And it was just expectations. Right? I mean, in the same way, technical analysis often worked with expectations. The economy does well. So if everyone is expecting a recession and it doesn't happen, then you have to have a gearing up phase over time where companies bring up their inventories, their hiring, their investment. And if you apply that same framework to the present, the labor markets are slowing. That means that incomes are cooling off. We see that in wage growth, even among the people that are most competing with immigration, right? I mean, lower income people are actually seeing their pay slow more rapidly than people at the high end. The housing market, well, the Fed cut 100 basis points last year. A year later, the housing market's actually worse today than it was last year. We started the conversation talking about a government shutdown, so the government is pulling back, but more importantly, state and locals are pulling back, and expectations. I mean, what's the implied recession probability in the financial markets? Like less than 10%? That's actually below what's historically normal. So I think the risk for a slowdown in the labor market's actually quite elevated. And I think it's interesting that people are talking a lot about, the break-even rate on what keeps the unemployment rate flat. That's actually happening at a time when the unemployment rate's been rising more rapidly. Think about that for a second, right? So the unemployment rate is probably up 3 months in a row. And that's when this stuff about break-even rates has actually been getting the most traction in the marketplace, which I think tells you a lot about like where people are mentally in the economy right now. There's a lot of rationalizing away of bad economic news. To me, I think the housing market's an interesting sort of tell on where the economy is, and the fact that the Fed's been cutting and the housing market's been getting worse, and building permits are at their lows, and builders have hit their pivot point on margins. I think that probably means more of a down cycle in employment than is expected. And I think the Fed's doing the right thing by cutting. I've been saying that. I mean, they're kind of doing what I thought they would do. I think relative to where the markets are, my sense is that the markets probably aren't priced for enough cuts next year.
So Jim, I think you have a little bit of a different twist.
I'm the opposite here. I think that inflation is the bigger issue. I think the Fed is going to have to deal with inflation. Quick word about inflation. They're going to release the report Friday, whether the government shutdown is done or not. The reason they're doing that is they need this fiscal year end for the government September 30th. They need that number so they could set COLA adjustments for Social Security, cost of living adjustments for Social Security and the like. So everybody's afraid of the old people, and they want to make sure that they get their raises as soon as possible.
And there's an election next year,
too. And there's an election next year. And by the way, let's hear for government efficiency. The CPI number is effectively done, but they had to bring back 125 employees for 2 weeks to release this report. So they're very efficient over there. But let me just say this. I think that the thing about inflation versus employment is we've seen a lot of studies that say that the public fears inflation more than unemployment. They view unemployment as somewhat transitory. I might lose my job, but I'll get another job. But inflation is permanent. Prices go up. They never come back down. They just keep going up and up and up. And that's why even last year during the election, when you asked people what was the number one economic issue they voted on, it was inflation. And Biden/Harris was correct to point out, well, it was 9%, and now it's down near 3%. But they missed the idea of what a damage that did to the psyche of a lot of people, especially lower income people, and to a lot of household balances. So I've always thought that inflation is the bigger problem. When we get the report, if we go with Wall Street's estimates of 0.4, 0.3, we're still going to have a core inflation rate above 3% 5 years after the shutdown. That would be still a 3% core rate, would be higher than we saw anywhere between 2010 and 2020 and 2001 and 2008. I'm talking about the previous two recoveries. We're still 5 years later above that level that we've seen. So we've got an elevated inflation rate. Now, as far as labor goes, I am in the camp that we have to look at that break-even rate. And what that means is we know that the U.S. economy created in August, because that's the last number we got, 22,000 jobs, 29,000 on a rolling 3-month basis. We don't know what September was. We don't know, obviously, what October is just yet. How many do we need to create? Well, the answer that we usually give is somewhere around 100, 120,000 jobs, and that's always worked for decades and decades. But now, because of the closing of the border and increased deportations, the population growth of the U.S. this year started the year above average in January. It is now at the lowest level in 80 years because all our population growth is from immigration, and we've kind of ended that. So even Jay Powell acknowledged this in September, that the break-even rate might be between 0 and 50,000 jobs, with 25,000 being the midpoint. The Dallas Fed put out a study 2 weeks ago. They estimated it at 30,000 jobs. So when we look at 29,000 jobs being created over a 3-month period, is that a bad number? Historically, it looks terrible. But if you have no population growth, that might be all you need. And so that's why Jay Powell uses the term that the labor market is oddly imbalanced at a much lower level. Regarding the unemployment rate, it was 4.2% in July of last year, 15 months ago. August was 4.3, so it's only 1/10 higher in 14 or 15 months. Now, we don't know what September is. We don't know what October is. There are some estimates that those might have ticked up. We'll see if they did. But it's unclear as to whether or not what we're seeing in the labor market is a result of the population decline in the U.S. or some kind of broad economic slowdown.
So I would just say that a lot of the cooling in the labor market, I mean, if you're waiting for like a tell, it's already too late, okay? Like that's the risk, is that inflation doesn't actually move in a nonlinear way. Unemployment does. You know, the 3% inflation that Jim is talking about, that's actually not in the Fed's preferred measure of inflation, which is actually 0.5% lower than that. But I would just say that the tell, if you're waiting for layoffs, you've waited too long. And that's really what the Fed is trying to avoid here. And most of the weakness in the jobs market, it's not coming from layoffs. So the unemployment rate has been going up primarily because it's like water in a bathtub. It's draining out more slowly. People can't find work, so the level of water goes up even though the layoff rate hasn't. If you're waiting for layoffs to go up and like a big tell, then that's it, the game's over. So I think it's those nonlinear risks, I think, that are kind of, you know, I guess capturing the imagination of some of the people within the committee, the doves at least. But I would just say, look, I mean, you know, with respect to inflation, you know, I think it's notable that rates are where they are. I mean, we're talking about rates 10 years below 4%. Oil prices are down. You know, you talk about inflation expectations. The fact that retail gasoline prices will probably be sub $3 nationwide pretty soon, that's probably going to matter for household inflation expectations because those expectations are shaped by what you spend money on frequently. We're also, I mentioned the housing market. Rental inflation is disinflating. You talk to any apartment REIT across the country, they're talking about how rents are slowing. And, you know, wages. I mean, the surest sign of a tight labor market is wage growth. So if the labor market was that tight, you'd expect wage growth in job postings, for which we do have data because a lot of that is private sector data. But wage growth in job postings has been slowing. And you would expect that actual wage growth would sort of follow what posted job wage growth is. So I feel pretty good about the direction of inflation. I think if you're more worried about the unemployment situation, naturally you're not going to be as concerned about inflation. So you know, that's why I say, I mean, if the cuts were going to do it, they would have already done it by now. And the fact that we're still talking about home prices declining, we're talking about permits low, we're talking about builders hitting their pivot point. You know, I think the housing market is not getting enough attention, but to me that's an interesting tell on the outlook.
Well, you got the bull and bear there. Let's stay on the Fed. Powell's term will be coming up. And Kevin Hassett just moved up in the polls. I was checking the Kalshi betting market. And now Kevin Hassett has moved into the lead. But when I was having my pre-call with them, Neil brought up who he thinks is going to be the next Fed chair. And that's not even in the polls. So why don't you give us your outlook, who you think will eventually be appointed by President Trump?
Well, what was Christian Bale's best superhero movie, Marianne? It wasn't Batman. It was Dick. And that's kind of what I think is going to happen here. So if you remember back then, Dick Cheney led the transition. Dick Cheney led the transition for Bush's VP search. And what happened? W ended up going with Dick Cheney. You know, it's interesting. I mean, a lot of these, I just feel like if a lot of these people that are being talked about, if it was going to be one of them, they would have named it by now, okay? So there's probably something about each of these people that the president doesn't like. In the case of Hassett, I mean, look, we're all adults here. The reason President Trump fired the BLS commissioner after a dud of a jobs number was because the jobs number itself was bad, okay? Within a span of 48 hours, NEC Director Hassett had everyone talking about data quality issues. That was the only thing the Sunday shows were talking about. Why would you want to give someone like that up? The fact that he can get you out of a jam by changing the subjects that quickly, if I were the president, I wouldn't want to get rid of him. So I think he's more effective as a spokesman for the president. Okay, then Warsh. I mean, President Trump has been playing footsie with Kevin Warsh, who in my opinion has had a litany of bad calls throughout his career. But he's been playing footsie with Warsh for as long as most of us have been in the business, for as long as he's been around, right? I mean, there was an article last year about how he was going to potentially be Treasury Secretary en route to the Fed chair.
NEC, he was going to have
maybe NEC.
Yeah.
He's talked about before. Okay, I mean, I think he's been passed over as many times as he's been talked about for positions in the press. Governor Waller, who I'm a supporter of, I think he'd do a good job as Fed chair. Again, I mean, President Trump doesn't want to have like a second Jerome Powell on his hands, right? Like, so the personal relationship is part of this. So, you know, I've seen Rick Reeder. I mean, I think he kind of is the same. I mean, the president wants someone that he probably knows. So I don't know. I feel like the longer the process goes on, the better Bessent's chances are, right? Where it's, what do we know about Scott Bessent? We know that number one, which is I think the most important, is that he has the confidence of the President of the United States, okay? The President views him as a trusted advisor. And number two, he has the confidence of the financial markets. So those are two, I think, important qualities. So I feel like, and I would say number three, like, if I'm him and I'm interviewing all these people, I think I'm probably better than all the people that I'm interviewing. So, you know, I would just say give it time. I mean, it's probably, I just feel like these folks that we're talking about, they've all been getting talked about for this position for a long time. Hasn't named them. So I think the longer the process drags on, the better Bessent's chances are.
Jim, you want to add anything?
Yeah, I agree with that Trump has made it clear that his first choice is Bessent. He's made that very clear. And Bessent has turned him down. And I agree with you that, you know, what's the delay? We've had these same names for months and months, and no one has been picked. And I agree with you further, just to emphasize some of the points that Neil made, is Trump wants a 1% funds rate. And he wants somebody who's going to go in there and they're just not going to care what the data says. We're going to 1. And he doesn't trust Waller. He doesn't trust a lot of the other players that they will do that. Once they're independently confirmed by the Senate, they could, as you pointed out, become a Prowl 2.0 and then say, well, circumstances have changed and we can't do that anymore. And that's not what Trump wants. So he wants somebody he trusts, and he wants somebody who agrees with him that we're on our way to 1% come hell or high water on the funds rate. And that really leaves him with, you know, that really leaves him with Hassett, and that leaves him with Bessent. And I would not be shocked if he twists Bessent's arm enough that he winds up with a third job. Because remember, he's not only Treasury Secretary, he's also the head of the IRS. So why not be the head of the Fed too as well? You know, just throw them all in there too. And you know, maybe he could coach Penn State. They need a coach too. You know, just let him do everything at this point.
It's wonderful to have these conversations and pontificate about all these wonderful things in macro, but a lot of these people have to make money for their clients. And Jim, you're an expert on the fixed income market, and you have your ETF. So when people call you, how are you telling them to position in the fixed income markets?
So we have an index that we discretionally manage, and I could just tell you how we've got it set up. I'm more worried about inflation than I am about growth, so I've been positioned defensively in the index. We've been 90% our benchmark duration, which means we're less sensitive to movements in the bond market, which would benefit us if rates go up. We've been recently now more in a bulleted position where we have an overweight in, say, the 5 to 10 year sector and an underweight, you know, less than 5 years and more than 10 years. That would be a position for a steeper yield curve. That's a little bit kind of saying the same thing as being short duration. We're underweight credit because your relative weighting in a fixed income portfolio in credit is kind of your stock market outlook, and I'm a little bit concerned about the valuations in the stock market, but fortunately we've been overweight in mortgages, not in treasuries, so that's helped us because underweight credit has not been a good place to be, but overweight mortgages has been an okay place to be. It's not been as good as being overweight credit, so it's kind of offset that. And then we've got some other positioning where we have some local currency emerging market debt. That is a high yielding bet on a falling dollar that's worked very well for us this year. And we've also got short-term Treasury inflation protected securities, short-term be 0 to 5 years. I don't really like owning duration with tips. I like to own them very short-term as a bet that inflation expectations might be heading higher. And on that point, it reminds me, I wanted to say one thing about inflation expectations. You're right, gasoline prices are coming down and crude oil prices are coming down, but inflation expectations have been somewhat sticky in coming down. And I think that's more about tariffs, that people are seeing that tariffs are still pushing prices up because in all regressions, inflation expectations should be much lower right now. We're given that we're in the mid-50s on crude oil prices and pushing $3 nationally on gasoline prices, but we're not because of tariffs. So there is that latent inflation fear, and that's why we've got this positioning in Treasury inflation protected securities.
Anything in high yield?
Not at this point, because that would be where, like I said, I'm underweight credit. Well, high yield would be that. At some point, if I warm up to the valuations in the stock market as a fixed income index provider, I would be overweight credit and possibly in high yield. So not yet is the way I'd say it.
So Neil, you don't really do positioning, but you talk to a lot of institutional accounts, and I'm sure you pay attention to what's going on in the fixed income market. And you seem to be a bull on interest rates, which would translate to be bullish on the fixed income markets. Are you seeing anything in the fixed income markets, whether it's your opinion, how do you see maybe clients positioned or how they might be changing their positioning within fixed income?
I mean, I think relative to where I am, I mean, most investors, I think, are a little bit more in Jim's camp on interest rates. They think that after the Fed is done cutting a couple of more times, that rates probably back up. I'm not so sure. I mean, I think that'll probably, if such a move were to happen, I would probably start betting on even more cuts next year because, as I say, like ultimately, there are too many parts of the economy that simply don't work with interest rates where they are. Therefore, interest rates need to be lower, and that goes doubly for the housing market. With respect to equity investors, a lot of what I hear is just, I have to be invested. It's like I hear what you're saying on the economy, but I'm going to lose my job if I'm not invested. And so, I would just say, like, if I'm trying, I mean, I leave most of I leave the market kind of strategy work to my colleague Jeff DeGraff, but I would just say from like a very high level, there's something a little incongruent about the nominal growth environment that appears to be being priced in by the fixed income market and the one that's being priced in by the equity market. And the only thing that kind of squares that circle, in my mind, Marianne, is productivity growth. I mean, right? Like if productivity growth is going to boom, then it makes sense. That's kind of the release valve for all this. But that's really hard to tell in real time.
You're leading me into my next question. AI is supposed to bring all of this wonderful productivity to the market, but it probably, if you add in, all the AI stocks, including utilities, you're almost 50% of the S&P. That's a lot of concentration risk. So when you're looking at AI, how are you factoring this in? Why don't you, since you started with productivity, will productivity improve? Will it be positive? Are you concerned about concentration risk in the market?
Well, I mean, I'll speak to productivity. I mean, I think first, what we're talking about right now with respect to productivity, in my opinion, is largely just a data disconnect, right? I mean, productivity, when we talk about it in GDP, is really just a residual, right? It's output and hours, and the gap is productivity. And so what do we know about the most recent data? We know that GDP has been very, very strong, and employment has been very, very weak. And so as a result, productivity looks very, very strong in the third quarter. And I think that's what's getting a lot of this enthusiasm going. Historically, you don't tend to see productivity going up alongside the adoption of the technology. Like that typically is not what happens. What happens is the productivity comes sometime after there's been an adoption period. So for example, think about the personal desktop computer. That was probably making its way through corporate America sometime in the early 90s. It wasn't until the mid to late 90s that productivity really started taking off. So yeah, I mean, I don't really see much of a productivity boom yet. And again, I mean, if workers are getting more productive, shouldn't companies want more of them, more of these productive workers, but in fact, labor demand has been slowing. So that's why historically, in a genuine productivity boom, you tend to see employment strong and productivity strong, and that's not really what we're seeing at the moment. So it could happen later, but I don't really see much evidence of one right now.
Jim, I think you have some strong views on productivity.
Just to feed off of one thing that Neil said, Bill Gates in the late 1990s, talking about the rollout of the internet, said that the gains from the internet over the next couple of years, 3 years, is going to be less than what you think, and over the next decade plus, it's going to be more than what you think. And that turned out to be exactly the case. If you remember back to late 90s, early 2000s, we thought we'd be by 2001 where we are today with internet retailing, but it took us 10 or 15 years to get there. But we eventually got there. And I think it's the case with AI. I think AI is going to be as big a deal as the internet, if not a bigger deal than the internet. But not next year, not the year after. It's going to take more time for it to start to unfold. And also, I'll channel Bob Gordon, who's an economics professor at Northwestern University, who's done some studies on employment and technology. And he says that in technology is a net creator of jobs, net creator of jobs. We've heard the estimates that maybe 50 million jobs or up to 100 million jobs could be displaced in the economy. There's only 160 million to begin with because of AI. Okay, maybe that could be the case, but it will create at least that many jobs, if not more. The problem is, I can tell you the job that's going to be displaced. I can't tell you the industry that doesn't exist that's going to come because of AI, that's going to employ millions of people. So everybody gets afraid of technology because they can't figure out what's coming next, but they can't see who's going to lose immediately. And that's going to be the biggest concern that we have on the employment front. As far as the technology, you're right. If you go to Michael Kemblis at JP Morgan, he's got 47% of the S&P is now AI or AI-related stocks right now. So it's roughly half. And we've never seen a concentration like that before in the market, that so much of the index, the S&P 500, is tied up into one theme in terms of AI. It's got a lot of parallels to the late 90s. In the late 90s, what we were all getting excited about was Global Crossings, JDS Uniphase, Cisco, the infrastructure bet. And the infrastructure bet came, and then we had the correction. And then what was left with at the end of the correction was the internet. And then we got the content companies. We got the Facebooks, we got the Googles of the world. It was like, now that we have the internet, what are we going to do with it? And those were the content companies that came. Well, right now we've got the infrastructure play led by NVIDIA, right? We're all building out, we're building chips, we're building data centers, consuming a tremendous amount of power. And then we'll get the ultimate correction. And then within that correction, we'll then be left with AI. And then we'll ask the question, what do we do with it? And then the AI content companies will follow. Now, the problem with the AI content companies, as I heard in an investment conference a couple of weeks ago, is the people that are going to create those AI content companies are probably in 7th grade gym class right now. So it's going to be a little while before we get those companies coming. But that's going to be the life cycle of what we see right now. So we're in the build-out stage of AI, just like in the late 90s when Cisco was the largest market cap company. We were in the build-out stage of the internet. And then the next wave up will be the content companies. And that's where the concentration in the valuations have me a little bit worried. And I'll just say one quick word about valuations. It's not that these companies are insanely valued. I mean, they're not cheap. It's that the market is pricing in every single AI play as a winner. And they did it in the 90s too. Put .com in your name and your stock price tripled. Oh, that means everybody's going to win because they do it? No, not everybody can win. Remember pets.com back then? Well, that's going to be the same thing here. Not everybody's going to be a winner, but we're pricing everybody as a winner, and that's why you get these insane numbers on the build-outs, because everybody's deal works, because the market rewards me for doing it, and the like. And so there's where the problem becomes in, where you get the overbuilding, and when you have the inevitable correction, you're still left with AI. So it has a lot of parallels to the late 90s. It's not all bad, but it is a very concerning point right now.
So let's go to questions. Let's see what the audience wants to talk about. If you have a question, please raise your hand and a mic will come your way. Don't be shy. I have a lot more questions I can ask, but I want you to have an opportunity. Do we have a question? A couple of questions down this way. Wow, okay. Now we have...
Unemployment, at least in 2025, a lot of the job losses have been federal workers. And I don't know, maybe how much do you think that explains the productivity gains, or maybe a lack of concern of the job losses?
I mean, a lot of the federal government job losses are happening now. Most of the productivity people are talking about happened, really before the federal job losses got going. So I don't know that has, I mean, I get there's always, like, federal government workers are always a very easy sort of punching bag, but you have to ask yourself, like, is there going to be some inefficiencies as a result of this? Because typically the people that take, like, these buyout deals, they tend to be, like, the more experienced workers. They tend to be, in career civil service, and now they're gone. That to me is, potentially could be weighing on productivity in terms of how government services are delivered. So it's something to think about. In terms of how much all of this means for unemployment, up through the end of September, which is when these people took this buyout deal, it's an open. I mean, I don't know how much that's going to weigh on unemployment, because some of them may not even be actively looking for work, right? I mean, typically when people take buyout deals, they tend to be at or near retirement. So, why would they actively be looking for work once they take this Doge offer?
We have a question right back there.
Yeah. Oh, me?
Yeah.
Okay. Oh, thank you very much. Yeah. As obviously AI is for keeps, and as it makes its way into our economy, as more companies utilize AI tools to be more productive, to what extent can you? And this is for both Jim and Neil. To what extent will it could it push up the floor on the unemployment rate? Could we have permanent unemployment of 5% or more?
Well, we certainly have concerns about employment
years because of AI. Could you foresee that scenario?
I think what you're asking is in a world of AI, does that raise the minimum level of education that you need in order to obtain a job in this kind of environment? So therefore, if you're talking about pushing up the floor, are you asking, do you need to have more education now to get a job because of AI, or less? I'd actually argue you might actually need less, because AI will do a lot of those functions that you needed to have the education for. Timing-wise, yes, it could push up the floor, because you could see, if AI tools come in, you could see more unemployment sooner before those jobs are created later. I'll give you one example real quick. Self-driving cars, self-driving transportation. Everybody uses that as an example of AI. Well, we won't need anything called driver. We won't need a bus driver, a forklift driver, a train driver, a taxi driver anymore. It's going to dramatically lower the cost of transportation. And what that will do is that will open up business models that don't work right now. Mm-hmm. And they will work. And that will create whole new industries in delivering products, because they're much cheaper to deliver in the future when you've cut out some of those costs as well. So, yeah, if your question is, do you need more education to get a job in the future because of AI, I'd argue it might be the opposite. But yes, on a timing basis, the unemployment rate could go up sooner before those new jobs are created and come down later. And last kind of big picture thing that Bob Gordon. Yeah. Okay.
Neil, yeah.
Go ahead.
We got to wrap this up. So let Neil.
Mm-hmm.
Where are you with AI or robots replacing us and unemployment?
Well, this is
rising?
like the so-called lump of labor fallacy, right? Like, so labor is the scarcest resource we have. And so if there's a technology that displaces labor, it tends to free that labor up over time to go into even more productive uses in the economy. So I don't really think there's a long-run trade-off between the two things.
All right, well, we have 1 minute left, so I'm going to ask them a very quick question. The best performing asset year to date is gold. And I don't think that was on many people's list. Do you continue to see gold go up, yes or no?
Yes, because it's a small asset class. It's being driven by Asian buying, and silver's up even more than that for kind of the same reason.
And silver will also continue to go up.
Yeah, it's up 70% this year, silver is right now.
Poor man's gold.
Yeah.
Neil, where are you on gold?
I have no idea. My only use for gold was when I got married, Marianne.
That's very expensive too, by the way.
But at any rate,
you got married during the bear market, so it was cheaper.
Well, I mean, it's yeah. But my colleague Jeff just put a report out on it, so I'll refer you to that about gold.
To Jeff DeGrasse, REMAC. Well, let's give these gentlemen a round of applause. You're doing a terrific job.